Hi, welcome to the Market Alert for Tuesday, the 13th of December 2016. So yesterday we saw the market start off sideways, and no surprise really, and today is going to be the same as the market waits for Yellen's decision tomorrow. Hurrah, we've actually got to within 1 day of waiting for a year to see whether she's going to increase interest rates or not. So yesterday, this is the live data from yesterday. I'm just going to fast forward it so you can see what happens. You can see there we had a buy signal. The market then moved higher after filling the trade, but unfortunately didn't have enough momentum to keep going. And you can see there that the most on this trade, if I just bring it back, was when we had the little spike there to the upside. There we go, just about there. So 15.5 points was the best the market could do with this trade, and then it reversed, put in a sell signal, moved lower and stopped the trade out for 23 points. And then eventually the market traded sideways, put in another buy signal that wasn't filled, and eventually it worked its way down to the scalp level and just beyond there. I'm just going to bring this back so you can see there's 25 points there as it's driven through to actually pull back the loss off the first trade, and that's about as much as the market did for the remainder of the session. Very narrow range, but again, to be expected. Plenty of signals, but just not being filled, and that's fine. If they're going to be losing ones, I don't want them to be filled. This one's late on in the session, 8 o'clock. Well, I'd already sent a note out to say if the momentum didn't improve, and it just didn't improve. There was just nothing, as you can see here where the market's traded sideways. So in the daily charts you can see the market's continuing to move higher, and there was a report out on Zero Hedge with the headline, "The Dow is the most overbought in 20 years and options traders have never been more bullish." And that's not strictly true about this bit. I'm not going to go into the complexities of covered call buying options and all sorts of other strategies, so they could be slightly misrepresented, but I like this bit here. It says, with the Dow 20,000 one good algo ramp away, it is perhaps worth noting that the index is dominated by Goldman Sachs performance and has been overbought for 22 straight days. So you can see why the Dow's up. It's the banksters again marking their own shares up, and you can see how this has brought the Dow up and allowed it to continue to move to the upside. So the all-time high of yesterday's pre-market session of 19,872 remains. You can see the markets trying to move higher on the overnight. I expect it to be sideways to date, maybe worth standing aside because Tuesday and Yellen speaking tomorrow, and then the party can start after tomorrow. Now, my sort of hypothesis of this, they need to get to 20,000. They want 20,000 before the market moves lower and they get a retracement and profit taken and whatever. And the way to do that, of course, is to wait until Yellen makes an announcement, and then they'll use it to their advantage to move it up to 20,000. It will go through 20,000, reverse, and then likely to come back, and then that will be the last time you see 20,000 for some time. That's how it's worked in the past. Suck everybody in, get them to think that the increase in interest rates, if she does increase, is actually a positive thing, not a negative thing. That'll allow the traders to move the market up to 20,000, trouser the profits, and then leave the sheep and the traders that don't know how these banks operate left there holding the baby, as it were. On the implied volatility, let me just show you what I'm up to with this. This is a 3-month chart, and this includes the price bars with the implied volatility overlaid. And the great thing about this is, with creating these charts myself and in a spreadsheet, I'm able to then determine where the market's likely to do what it's going to do based upon those simple rules of when we get down to the 10% area, the market tends to move lower. This is just prior to the election, of course. And then when it doubles in value from 9.84 there to 18.9. The down moves over, and then we see the market moving to the upside, and we're seeing this pulling back. There is a bit of an anomaly here at the moment, though, because even though the market's going higher, there is a situation where the implied is also, and this happened on Thursday too, which is this little peak here. And that to me says that the options traders are aware that we're in territory that we've never been before, i.e. 20,000, and it could get slightly hairy. So they're sort of, starting to hedge their bets, as it were, and just marking up the options just a little in advance and anticipating that potential outcome that we will see the Dow move lower once it's hit the 20,000 psychological level. So no surprise really. I mean, normally you would get a situation where it just kept dropping, like in this situation here. It would just keep moving lower as the market moved higher. But there are a couple of clues here that as we approach the 20,000, we are going to see the potential for the market to correct profit taking. And if she increases interest rates, we all know what happened last year. I don't know if I have the chart with that on. Oh, I do, yeah. This is the 1 year one. And this is... we got down to 12% in between December and January there, and then we saw the market lose 2,000 points, and we had 24%, 25%, nearly 100% increase in the implied. And then when you mark these down, you can see the market double bottomed as well, and then we saw the market move higher. And this coincides with the phone call from Yellen, which I showed in yesterday's market alert, and you see the market moving higher. And as it moves higher, there's no more risk to the downside, so the insurance, the implied volatility aspect, starts to drop off. They don't see much of a risk, so they can sell the options cheaper, but very expensive here and reasonably cheap here. We also get a correction here back in June, which is the Brexit, and again you can see from 10, I haven't got the peak on that one, I think it's about 8, it's just there, it's moved, it's 18, so nearly 100% implied there. And again you can see once the Brexit risk is out of the way, the market moves higher. And then as we get towards July, August, a bit of a risk there. You can see the market just peak up, but we don't get 100% increase there. We only go from 8 or 9 to 15, and then eventually we get just after the election, the market drops, not much, only 500 points. See the market drop, and then we get the 100% increase. The froth is in the market, and then we've seen what we've seen in the last week. In the last 25 days, where the market's moved higher. So it is a brilliant way to actually see and forecast what's likely to happen. This is something I uncovered in 1993, 94, and have used ever since. And it's a great way of getting a gauge on what's actually happening in the markets and what's likely to come. So when we get down to these levels, we know we've got a correction due, and then you just overlay the fundamentals, see what's coming down the line, i.e. rate increase, Yellen. The same here, we've got US election, and there we had the Brexit. So we got down into the lows, then we had the Brexit, got the 100%, and then we see the market then free to move after. So we've got a correction coming. It's just a matter of how it plays out, and as I said earlier, I think it will play out, get to 20,000 and then get the correction in. And if the interest rates go up as well, which seems to be 100% consensus that that's going to be the case, then we will see some fireworks between Christmas, New Year and into January. So let's just, one more thing to do, isn't there? Is news, anything out today? No, nothing out. When the market's open, it's Tuesday. Tuesdays can be difficult. Market sideways. Yellen's tomorrow. So again, make the decision, think about it. If there's no volatility in the first hour, there isn't going to be for the rest of the session, because it's a very, very important announcement tomorrow, which would see the interest rates go from 0.5% to 0.75%, which it doesn't seem a lot, but it is when you're sitting on 4 trillion of debt and you have to find the interest payment on that. So let's wait and see. That will do it for today. As ever, thanks for your support and also for watching. I shall see you in the next one.